This is the story. We'll go to the screen here and I'll read this through because you sent me this one. I was like, oh man, yeah. This happens. Doesn't happen to our clients, but this happens, and this happens a lot at scale, right? Okay, and the headline reads, it's daughter hit with a $660,000 tax bill when both parents died in the same year. Okay. When both parents died in the same year. So we'll go through the scenario. So Ontario woman says she had to use nearly all of her parents' retirement saving plan to pay off more than $660,000 tax bill if they both died within the same year. Okay. Ashley said she and her brother were grieving the loss of their parents and they received the tax bill from the government. It made me more angry than anything. We lost both parents inside of 11 months. Okay. And we think, we think my dad died of a broken heart. This is actually like, this is a real thing. You know what I mean? This is like anecdotally, like I experienced this, it's like, I've been doing this long enough where you see people pass away, and it's really not unusual when someone close to them passes away. When one spouse passes away, that the other one is not that far behind, right?
Yeah, that's true.
And the default in RSP is like, it transfers to their spouse, but usually that other spouse isn't going to outlive them, right? It's like we just don't have this real discussion on RSPs. It's just like, oh, that tax is someday. It's like, this thing, I tell everyone, is like, I wish these things just came in the mail and it said this is a joint account between you and Mark Carney.
Yeah.
Like it is just, it is a joint account. You are never getting 100% of that out. You feel good because you see that number, but it's not yours. You're going to lose, in 99% of the cases, you're going to lose 25 to 50% of that in tax at some point. Like that is, how this thing is going to materialize, right? And before the people out there, it's like, oh, but you get your credits and your tax free, like your CPP and your OAS are going to eat up most of those credits. Like you're paying tax on that RSP withdrawal. This is over and above. So you're going to pay somewhere between the first rate and the top rate, right? So that's how these things materialize, right?
It's not a gift from some benevolent government.
And if you're a financial advisor out there saying like, well, your income is going to be so low, it's like, what the hell did you do with their funds during their working years that their rate of return is that low? Like, what were you doing up until this point if you don't have any investment income? Like, these guys, they just like drive me up the wall. Like, this is like the quintessential problem because these people, didn't deserve that, right? Galen describes her parents as middle class, working hard in their careers in nursing and business to save up to buy a cottage in 1998 and contribute money to their registered retirement scam plans. Okay. And when they both died last year during the same calendar year, Gailey's mother RSP rolled into her father's RSP for a combined $715,000. So yes, it will roll to the next spouse. Yes, but you haven't solved the problem. Your RSP is not intergenerational wealth plan. It's a tax confiscation plan.
Yes,
it's a partnership. It's to turn your investment income that's otherwise taxed at better rates into the worst type of tax at other income rates and withdrawn all at once on the date of death eventually. That's what's coming, right? Okay. And so when her father died, the RSP amount had to be taxed as income at about 50%. 50%. So not at a capital gains rate. You're not getting, eligible dividends at preferential rate during the life of it. It's like, it's all going to come in as other income at 50% on the date of death. Could be, it could be a little less than that because you might have some use of your other marginal tax brackets before them, but this is common. Like this is common for people who have substantial RRSPs, and I see them and it's like, they come in and they're at retirement and they got $1 million in RSPs. It's like, what are you doing? Like, what are you going to do with this? Right?
Yeah.
Like this is a very serious problem because you're in basically a punitive tax vehicle. And the longer you go in that punitive tax vehicle, the worse it gets. Okay. And this is further compounded by another common problem that other people have. Okay. So even though they lived at their cottage for the last 5 years, Revenue Canada still wanted a portion of their capital gains of that property from the time they owned it from 1998 to 2019. So, a lot of Canadians have more than one property. This is a common thing. They save up to get a rental property, they get a personal use property, a cottage. Okay. You can only deduct, you can only protect as a couple one residence as your principal residence. Only one residence as your principal residence. It doesn't have to be the one that you live in the most. It has to be a residence that you ordinarily inhabit, but only one. Okay. So in this case, it looks like they had another residence in the city that they were using to protect their principal residence, and then they sell the house in the city in 2019, and so now they're protecting the gains on the cottage from 2019 moving forward to 2024 or 2023. But it doesn't negate the gains from 1998 to 2019. So yes, you can. Someone told them you can roll that. You can defer the gain on that, and yes, that is the case. You can defer the gain on that. But again, it was just someone kicking the problem down the road. It was a tax advisor kicking the can down the road, saying, "Yeah, we can defer that gain from 1998 to 2019." What they should have said is, "I have no idea how to get out of it after that, though." You know what I mean? Like,
I have a question though. Okay.
Yeah.
So the cottage was, really their secondary property up until 2019, 2020, when they decided to move into it and turn that into their primary residence.
Mm-hmm.
Now, it says in the report that the government wants the gain from 98 till 2019, 2020. How are they going after that gain? Just because they died, or the inheritance tax?
They
I
changed
don't
the
understand
use.
that. Yeah.
So when you change a property use, so when you change it from personal use or principal residence or investment property, there's a deemed disposition for tax purposes. So in other words, there was tax owing on that gain because it was a personal use property from 1998 to 2019, not protected by the principal residence deduction because they had another property protected by that at that time. And so there was a deemed disposition. But there is a provision in the income tax to let you defer that gain. So really, when they filed their 2019 return, they had a gain, okay? But it was deferred, which is allowed. You can defer it. But again, it's not a strategy. It's, it's a Band-Aid, right? It could have been part of a strategy, but it's not a strategy, right? Just like that RRSP, okay? And this is the problem, right? Someone was filing that return year after year after year, and someone, probably one of the big five banks, I don't know for sure, but the law of averages, probably one of the big five banks, managed that RRSP. And they talked to these people probably year after year after year and showed them some automated report and did not understand this massive, massive issue that they had, which should have been ridiculously obvious, which would have been ridiculously obvious to someone like me walking through the first initial client meeting. I'm like, oh my goodness, we have this issue. We need to act, right? And making some difficult choices, coming to the realization that that RRSP account is actually a partnership with the government. It's never coming out tax-free.
Right.
Okay. So we have to minimize the tax on those withdrawals. And now we have this piece of real estate, which there are strategies to pass real estate to the generation, either in part or in whole, without tax to future generations. And it really does coincide with their liquid investments, right? But I have yet to see a big bank financial advisor ever, even though they're managing most of the wealth in Canada, ever come up with an effective strategy on how to mitigate this, right? All they do is they just sell you underperforming assets with high management fees year after year after year, and they once in a while they'll throw fancy events, but there's no real strategy that I ever see out of it, right?
No.
So, I mean, that's what I had. And these people walked towards that. And so then what happened was all of that tax became due on the date of death. So it was deferred. The RSP tax was deferred when mom died to when dad died, but he died in the same year. And the previous deferral that they recognized in 2019 on the gain of that cottage was at that time. Okay. This is a quintessential Canadian example. Massive RRSPs, second property with massive gains, no way out, no strategy, no planning at all, right? And here, I'll give you another wrinkle of it. This doesn't say this in the article, but a common, a common, further complicating factor is there was probably some debt on the cottage.
Oh,
Can you imagine that? Like, so now the next generation, not only is all the savings evaporated, because that RRSP, I think it says in here that RRSP was $715,000, and the final tax bill was, 660,000. So like 94% of the RRSP, the savings is gone, right? And they probably have to pay for their final filings of the same guy who didn't recognize this was coming for years, and a lawyer to do the probate. So of course they got to pay for a funeral and that sort of thing too, right?
Yeah.
And I like how it throws in there that, but they had a little bit of life insurance, as if that's a strategy. So we're going to buy this other underperforming asset to pay this outrageous tax bill, rather than try to allocate your assets to avoid the tax bill in the first place. Like, that drives me up the wall with a life insurance salesman pop in. It's like, you could have bought this life insurance policy, yielding 4 to 6%, when I could have showed them how to get 10% plus tax free. So this is, the example is, like I said, the complicating factor that a lot of people have. Big RSP, they have a gain in a second property that with nothing on it, and then a lot of times they have debt on that second property. So now the person inherits next to nothing, and guess what? They got a mortgage payment. They might not even qualify for the mortgage.
Oh man, so they lose the property,
and sometimes they got to sell it like fire sale type sell it, right? Because they can't even they can't keep up with the mortgage payment, or they can't requalify for the mortgage, and then the whole thing, and then maybe you got a second property and that's worth $800,000, but you got to dump it at a time that's like now when interest rates are high, and you end up having to dump it at less than what you would in a regular time, right? This is the quintessential problem. And, we see them, and there's just like hundreds and hundreds of thousands of dollars or millions in registered accounts, and no way out, and no strategy at all being applied to these, right? So this is the example that people are walking towards, right? And I think a lot of it, Trevor, has to do with the misconception of like what retirement should be, where the kind of the poverty mindset in retirement is, I'm going to sell off my assets as I die.
Right.
I'm going to sell off my assets as I die. That's not the goal, people. Like I start like eliminating, like when we start doing our plans, I start eliminating the word retirement because I think it's stupid. Yeah. It's like, I'm going to just sell. Well, how long are you going to live? I don't know how long you live. So what if you sell them off too quickly? Or what if you don't sell them off quick enough and you die with a massive tax bill?
Right. Well, I mean, we've talked about this a lot of times. I think the goal is to pass it to the next generation, right?
Yes.
Doing it in a wise and well thought out way, to the next generation through trust, through family office, through some way, so that wealth is it grows and it's preserved, and it grows for generation after generation. I don't know where this stuff came from, where we are encouraged to completely eradicate all of our savings, so that all the struggles and all the trials and all the hardships that we had to go through to build and generate wealth, we got to make our kids go through that same thing. It's like, that's
in a worse environment, because the wages buy less and less of the desirable assets.
Yeah.
You know what I mean? Parents bought houses with 6 years of median income, and we buy houses with 16 years of median income, and our kids are going to buy houses with 60 years of median income. Like, this is coming. And so, like, I tell people, it's like, eradicate the word retirement from your dictionary. Start there first. This is, this might be a hard shift for people to do. Yeah. The goal is not retirement and sell off your assets. The goal is financial freedom. You obtain financial freedom when the dividend income and the rental income of your investment, so the investment income, exceeds your living expenses.
Yes.
That is the goal.
Yes.
That is the goal, because the other lie that everyone's trouncing towards is like trying to predict their date of death, as if they're, Nostradamus or something. They're also saying we can predict the rate of inflation. while the dollar is self-destructing before our eyes,
Yeah.
right? So I see them like laughably apply this like 2% inflation fee as if it hasn't been speeding up at all, and as if that $100,000 is going to feel like 100,000, as if I increase that by 2% a year, that's going to feel like the same purchasing power in 10 years. Like, it's not, people. It's not. So you need to derive dividend and rental income that are actually going to keep pace with real inflation, where I can actually raise rents, and I'm actually, I have stocks that generate a yield that have pricing pressure on their customers so they can raise prices. I don't want to sell those units. I want to acquire those dividends, right? And then that's how I show people how to do this, right? It's like, that is the goal. And whether you're 30 or whether you're 80, you're free at that point.
Yes.
But if your goal is to sell off your stuff before you die, it's like, you better not help. You're too healthy, because it might not work.
Yeah.
And
even if you live to 95, right?
and
You're out of money.
And what inflation rate are you using on that? Because
Right.
why are you so sure on that, right? We've been telling people it's like, this used to be 6%, right? But you can look at the price of gold today. It's like, you could have bought lumps of gold and got 10%. You could have got a 10% compound annual growth rate in the last 25 years, right? At this point, like, beating the TSX, beating the S&P 500 by a pretty large margin at this point, right? But people don't understand the actual rate of inflation. And so, this is the warning sign, right? Where they're just like, well, what's the tax on that? What if they both pass away at the same time? It's like, well, A, they are going to pass away at some point, right? And B, like, the goal wasn't to sell the stuff off. The goal was to generate enough income that you're not selling off, that you're living off the investment income of those assets. But most people don't have a hope of doing that because the assets that they're in are so underperforming. Just like the tax advice of whoever sold them this RRSPs, the investments themselves, I'm going to guess that they're just similar to most of the balance funds out there in the big banks, and they're 5 or 6%. 5 or 6%, right? So, you're not actually keeping pace with the real rate of inflation. You're actually, your wealth is getting destroyed slowly with 100% certainty, right? You got 40% of the wealth in underperforming bonds, which those institutions need you in those bonds because they hold those bonds as reserve assets. Between the top 5 banks in Canada, the top 5 banks in Canada and the top 3 insurers, collectively, they're worth about $1 trillion. And collectively, they have $2.5 trillion of bonds on their balance sheets. So why do they need you to have 40% of your portfolio allocated in bonds? Because if people stop buying them, they're bankrupt.
Yes.
That's it. Yeah. Not because it's good for you, right? I mean, one of my favorite clients, it's interesting to meet with him. He's a CFA. He's a chartered financial analyst, and I won't out him. He was a fixed income analyst. He's a fixed income analyst for a major municipality in Canada. Fixed income analyst he was before he retired. And you know what he doesn't own?
Bonds.
He doesn't own any bonds. So his entire life is analyzing bonds, but he has 0% of his portfolio allocated to bonds. And I don't know how he, the cognitive dissonance of doing that year after year, day after day, but he did it, and he's a happy guy. And it's like, oh no, I don't know. He compartmentalizes it well, but it's really funny that he's he's an expert in bonds, and he would just never buy it for his own portfolio, right?
Yeah.
And totally retired. None of this, none of this bullshit where you're slowly allocating into bonds over time as I get older. It's like, yeah, I'm slowly allocated into the asset that's destructing my generational wealth as I get older. That's a great idea. Yeah. Right. That's a fantastic idea, right? And so this is it, people. Who the reporter, what they should have asked them, who sold you those RRSPs? Who sat down with you year after year and told you that this was a good idea, right? Now I have a good idea. I would say with 80% certainty, it's one of those household names. It's one of those big 5, big 5 banks, top 3 insurers. That's who walks them through this garbage year after year, right? Where they just don't understand, people. That person who you're meeting with is they might know with all the best of intentions, but they actually just don't even understand money at a fundamental level. They just don't even understand money at a fundamental level. And they weren't willing to have the difficult conversations because it was just about, their assets under management. They increase their book of business and they get their trailer fee off of these things. And that's all it was, right?
All they're thinking about is today, thinking about their paycheck that's coming down the road, their commission check, and making sure that they're, get their 25-year coin for being at the bank for so long. And look how many assets I have under my management.
That's right.
The thing that really disturbed me about this story was this is, like you said before, this is a common Canadian story. People thinking they're doing the right thing. They're playing by the rules. They're working. They're saving in their RSPs. They were able to save up and get a cottage when it was affordable, and they did everything right, right. But then come death, and they wanted to transfer this to their kids. I assume they did, and they're punished for it, like punished hard. Like the person who dies, they don't get the punishment. It's the people who are left afterwards. And that's really what we're talking about is, having everything set up in such a way so that when you pass on, you're actually passing something on rather than giving the inheritance to the government.
That's right. In this, it's like they died early. Imagine if they died later. Now they've been drawing down that RRSP.
Right.
Guess what? They still owe the tax on that gain in the cottage and wouldn't have any money to pay it.
Right.
Right. They wouldn't have any liquidity to pay it after they had their wealth confiscated, slowly over time, because they're still going to pay tax on those RRSP withdrawals. They're still, probably eroding their real wealth away because they weren't earning enough inside of that RRSP anyways, right? And it's like, just think of how like nefarious it is, because they tell you it's like the advisor gets paid a percentage of your fee. Okay, they get paid a percentage, but look at all the scenarios where that puts people at odds. It's like, we don't do that. Like, we charge flat fees. It's like, if your portfolio is $1 million, or if your portfolio is like $3 million, the plan doesn't change. The amount of times that I'm going to sit down with you is like, it's not changing, because, I'd sit down with them and say, great, anytime I can get that money out of the RSP, if I can get it out of the first tax bracket, I'm taking that deal. But why wouldn't a bank advisor do that? Say they can, get money out at 25%. Say they can get $100,000 out of 25%. Neither of them were working 1 year. It's like, because what happens to that? Now that portfolio, they're not getting their management fee on $700,000. They're getting a management fee on $600,000.
Yes.
So they won't tell you to do that, right? They like that big number. They're a partnership in that too, right? Just along with the government is that bank advisor who's taking a trailer fee. It's like, people need to get control back of these accounts and actually learn this stuff, because what they're doing is not that. It's not that difficult. I guarantee you, Sally down at the RBC, who I always make fun of, is not some, a quant trader who's out trading the market at all. Right?
Yeah.
She buys what's on her screen, the 60-40 split.